Have you ever wondered why stock markets crash? It's a question that has captivated investors, economists, and historians for centuries. Welcome to our exploration of the history and patterns of stock market crashes. From the devastating Wall Street crash of 1929 to the dot-com bubble burst of 2000 and the global financial crisis of 2008, stock market crashes have left an indelible mark on history, reshaping economies, fortunes, and lives in their wake. But what exactly constitutes a stock market crash? And why do they happen? These are the questions we'll be delving into today. So buckle up as we embark on a journey through the tumultuous history of stock market crashes, unraveling the patterns and lessons learned along the way. All right, let's break it down. What exactly is a stock market crash? Well, the stock market is like a giant marketplace where people buy and sell shares of companies. When prices suddenly plummet and panic sets in, that's a crash. Now, crashes aren't just random events. They often have roots in economic cycles, investor behavior, and even regulatory factors. Understanding the mechanics of crashes is crucial for anyone dipping their toes into the world of investing. All right, let's take a trip down memory lane and explore some of the most infamous stock market crashes in history. In the year 1929, the world was buzzing with economic prosperity. But then, bam, the Wall Street crash hits, plunging the world into the Great Depression. People lose their life savings, businesses go belly up, and it's chaos all around. Fast forward to the late 90s, and the internet is all the rage. Investors are pouring money into dot-com companies, thinking they've hit the jackpot. But then, reality strikes. The dot-com bubble burst in 2000, wiping out trillions of dollars in market value practically overnight. Pets.com. More like pets-gone.com. And who could forget the 2008 financial crisis? It all starts with a housing bubble bursting, triggering a chain reaction of bank collapses and stock market mayhem. Suddenly, everyone's talking about subprime mortgages and toxic assets. And before you know it, we're knee-deep in the worst financial disaster since the Great Depression. These are just a few examples of how stock market crashes can shake the very foundations of our economy. They're like wake-up calls, reminding us of the risks and pitfalls lurking in the world of investing. But hey, they're also opportunities to learn and grow. Okay, so one would ask, what are the causes of stock market crashes? Well, stock market crashes are complex phenomena, often influenced by a myriad of interconnected factors. One significant cause is speculative bubbles, wherein investor enthusiasm leads to inflated asset prices, disconnected from fundamental value. When these bubbles burst, the rapid decline in asset values can trigger market-wide panic selling. Economic downturns also play a critical role in precipitating market crashes. A contracting economy characterized by declining GDP, rising unemployment, and reduced consumer spending can erode investor confidence and precipitate widespread market declines. Geopolitical instability is another factor that can contribute to stock market crashes. Events such as geopolitical tensions, wars, or major geopolitical crises can unsettle markets, leading investors to flee from risky assets and causing significant market volatility. Furthermore, regulatory failures or policy missteps can exacerbate market instability. Inadequate oversight, lax regulations, or poorly implemented policies can create conditions ripe for financial excesses and subsequent market corrections. Moreover, technological advancements and market innovations can introduce new risks to the financial system. Complex financial products or trading algorithms may amplify market movements and increase systemic risk, potentially leading to market dislocation and crashes. Psychological factors also play a significant role in shaping investor behavior and driving market volatility, often amplifying the impact of external economic and geopolitical events. Fear and greed are two primary emotions that can lead to irrational decision-making and herd behavior among investors. During periods of market uncertainty or downturns, fear tends to dominate investor sentiment. Fear of losses prompts investors to sell their assets hastily, contributing to a downward spiral in prices. This herd mentality, characterized by mass selling, can intensify market declines and exacerbate the severity of a crash. Conversely, greed can fuel speculative bubbles and irrational exuberance in bull markets. Investors succumb to the fear of missing out and rush to buy assets at inflated prices, disregarding fundamental valuations. This behavior can lead to unsustainable market rallies and eventual corrections when reality sets in. Moreover, Cognitive biases, such as overconfidence and confirmation bias, can cloud investors' judgment and lead to poor decision-making. Overconfident investors may underestimate risks and overestimate their ability to predict market movements, exposing themselves to significant losses. Confirmation bias reinforces existing beliefs, leading investors to seek out information that confirms their preconceived notions while disregarding contradictory evidence. Additionally, the herd mentality prevalent in financial markets can create self-reinforcing feedback loops, exacerbating market volatility. When investors observe others selling or buying en masse, they tend to follow suit, further amplifying market movements. Recognizing the influence of psychological factors on market behavior is essential for investors to make informed decisions and manage risk effectively. Strategies such as maintaining a diversified portfolio, staying disciplined during periods of market turbulence, and avoiding impulsive trading can help mitigate the impact of psychological biases on investment outcomes. Now that we understand the psychological factors driving market behavior, let's turn our attention to the warning signs that precede a stock market crash. Identifying these indicators is crucial for investors to navigate turbulent market conditions effectively. Firstly, overvaluation is a red flag that investors should closely monitor. When stock prices become detached from their underlying fundamentals, such as earnings growth or asset value, it often indicates that a correction may be on the horizon. Keeping a close eye on valuation metrics, like price-to-earnings ratios, can help investors gauge whether stocks are trading at sustainable levels. Secondly, excessive speculation is another warning sign of impending market turmoil. When investors exhibit irrational exuberance and engage in speculative behavior, driving prices to unsustainable levels, it sets the stage for a sharp reversal. Paying attention to market sentiment indicators, such as investor surveys or margin debt levels, can provide insights into the level of speculative fervor prevailing in the market. Moreover, rising debt levels pose a systemic risk to financial markets and the economy as a whole. Whether it's corporate debt, government debt, or household debt, elevated levels of leverage increase the vulnerability of the financial system to shocks. Investors should monitor debt metrics closely, as a sudden spike in defaults or credit downgrades could trigger a cascade of selling and market distress. Additionally, geopolitical tensions and events can have a significant impact on market sentiment and investor confidence. Escalating conflicts, geopolitical crises, or trade disputes can unsettle markets, leading investors to flee from risky assets and seek safe haven investments. Keeping abreast of geopolitical developments and their potential implications for global markets is essential for proactive risk management. Now that we've explored the warning signs of a market crash, let's delve into the profound impact these events have on the economy, investors, businesses, and society as a whole. First and foremost, stock market crashes can have devastating consequences for investors' portfolios. As asset prices plummet, individuals who have invested their savings in stocks may see significant declines in their net worth. Retirement accounts, college savings funds, and other investments can suffer losses, potentially derailing long-term financial plans. The broader economy also feels the effects of a market crash. Consumer confidence tends to plummet as people feel less wealthy and less inclined to spend. This decrease in consumer spending can ripple through the economy, affecting businesses of all sizes. Companies may cut back on hiring and investment, leading to job losses and economic contraction. Moreover, stock market crashes can exacerbate wealth inequality. While wealthy investors may have the resources to weather the storm and even capitalize on buying opportunities during market downturns, those with fewer financial resources may bear the brunt of the losses. This widening wealth gap can have long-lasting social and economic implications, contributing to social unrest and political instability. Businesses, particularly those reliant on access to capital markets, may face significant challenges during a market crash. A sudden decline in stock prices can make it more difficult for companies to raise funds through equity financing, potentially hindering growth and expansion plans. Moreover, declining consumer demand and tightening credit conditions can squeeze profit margins and lead to corporate bankruptcies. Furthermore, stock market crashes can undermine investor confidence in the financial system and regulatory institutions. When investors perceive that markets are rigged or that regulators are unable to prevent market manipulation or fraud, it erodes trust in the integrity of the financial markets. Restoring investor confidence and rebuilding trust can take years, if not decades, and may require significant reforms and regulatory oversight. On a broader societal level, Stock market crashes can have far-reaching consequences beyond financial markets. They can contribute to economic downturns, political instability, and social unrest, as individuals and communities grapple with the fallout from market turmoil. Moreover, the psychological toll of market crashes, including stress, anxiety, and depression, can take a significant toll on individuals' mental health and well-being. Despite the negative consequences of stock market crashes, they can also serve as catalysts for positive change and reform. Market downturns often shine a spotlight on systemic weaknesses and vulnerabilities in the financial system, prompting policymakers to implement reforms aimed at improving transparency, accountability, and stability. Additionally, market crashes can create buying opportunities for savvy investors, allowing them to purchase undervalued assets and potentially generate outsized returns over the long term. After a stock market crash, the road to recovery can be long and arduous. However, history has shown that markets have a remarkable ability to bounce back over time. As investors lick their wounds and rebuild their portfolios, valuable lessons are often learned. From the importance of diversification to the perils of excessive speculation, market crashes serve as sobering reminders of the risks inherent in investing. By incorporating these lessons into their investment approach, investors can better position themselves to navigate future market downturns and capitalize on opportunities that arise amidst the chaos. And that wraps it up for our exploration into the history and patterns of how the stock market crashes. If you found this video informative and thought-provoking, don't forget to give it a like, share it with your friends, and leave a comment below sharing your thoughts or experiences with market crashes. Thank you for watching.